So the camera is the whole screen? Or
Right
is...
there. You can see it. You see that dot?
Oh, okay, gotcha.
Yeah.
Gotcha.
So that's a screen if we need to have something up there that's important. If you like your bullet points or something like that,
Right.
if you want to do that in the future. So anyway, you guys, we decided to go live again. It seemed like there's still a lag. I'm gonna. I think I want to. Let me see. Let's see. I think it's
We
still
can
a
check
lag.
our phones for...
Let's see. Well, I guess it's not too much of a lag. It just looks like it's lagging on my end. So I'm not gonna worry about it. But yeah, like you go to my page, you can share when you feel like it. But anyway, okay, we're back. So the reason why I did another live, I want to do a quick Q&A session and review of what we talked about in the last video, just a short summary. We went over the different loans that we discussed for FHA and conventional, and understanding the requirements and things that are going to be needed.
Right. And I need to add something else to the loan programs that is so important. So I know, and I couldn't quite finish about the USDA loan, but USDA loan only allows you to use up to 41% of your monthly income for purchasing. So if you have already several monthly payments like a car note, student loans, credit card, we're required to deduct those monthly payments, and whatever's left, that's what you can use for purchasing a home. When you go with conventional, it goes between 45 and 50%. For FHA and VA, it can go above 50%. So that creates, basically, it gives you more purchasing power without having to pay off, basically, credit or credit cards or things that you have out there. So that gives you basically access to more purchase. So those are one of the key issues that you need to consider. Hey, yeah, USDA is a great program, but if I'm only able to use 41% of my monthly income, the house that I can buy is going to be smaller compared to any other program. So make sure that you keep that in mind, and you compare apples to apples, because most people go 100% is great.
You qualify for less,
but you qualify for less, and your closing period is 45 days. A regular loan typically closes between 20 and 30 days. So when you make an offer to that seller, the seller is going to consider all that. If they are looking to move quickly, you will be losing out, because it's 45 days compared to everybody else closing in 20, 25, or 30 days. So that's powerful, guys.
And oftentimes when the seller know that you have a USDA loan, they may not necessarily work with you because they maybe want to close sooner. So the offer has to be a good offer, because they're not going to want to have to wait almost 2 months to close. And that's the same thing with some of the down payment assistance programs. They may take longer because of the type of funding that has to get approved through multiple channels. And so that's something to consider. There's nothing wrong with getting help, but if you can eliminate that, it provides less stress on your end and a smoother transaction. I've sold homes to many of my buyers who got down payment assistance in different programs, and I've had closings where they did not have that. So everyone does not qualify for down payment assistance. The last live that we just recently had, someone had a question about rehab loans, and we wanted to make sure I addressed that in this video about the rehab loans. So explain to individuals, what is a rehab loan, what type of loan it is, and how do a person qualifies for that?
All right. So rehab loan, of course, is a property that needs to, we need to do a little bit more work in addition to what it is. You need to add either cosmetic stuff, or you really need to do a real rehab. So there are two types of rehab loans, and the ones that we run into, the most common ones are going to be, of course, a conventional rehab or an FHA rehab. I do have a breakdown of requirements and loan amounts. Typically, the interest rate is going to be different from the typical regular loan. Also, your credit score may need to be a little bit higher. So it's all about the specifics, and those type of programs are out there for you guys. We offer them at Gill Mortgage. We actually have a team that specializes. All they do is rehab loans. So if you are looking to go that route, please let anybody with us. They will be able to assist you, help you. Of course, we need to take an application, make sure we have your credit run, and then we turn around and reach out to the team, the rehab team with Gill Mortgage, and they give us the specifics on what you can do. So that's all they basically do for us. So sorry about that.
It's okay. No, I wanted to. So when it comes down to the rehab loan, everybody wouldn't qualify for that. And is there a time frame that the house has? Is it like a home that needs a complete remodel, or something that may need work? The time frame to actually close on that loan, and is funding provided beforehand? Because obviously, who's going to pay for the work to be done with the contractors, or the contractor's going to have an agreement to get paid at closing?
Right. So basically, for the rehab loan, of course, you have to have three different bids. You choose between those. We close on the purchase price per se upfront, and then you have to be reviewed after the repairs have been, or the additions have been completed, and that's when the contractors get paid. So it is a more intricate type of loan, and I haven't done one in the last year, so I'm not going to be I'm going to be upfront and say, hey, I haven't closed one in the last couple of months. So definitely, if you want to do a rehab loan, check with the lender that is able to close that successfully and take it to completion, because there are so many moving parts, and not just you and your agent and your seller, but also your contractors. They of course they need to be licensed and bonded. So the process can take up to 3 months, up to 6 months. There are limits in terms of how much you can borrow, so keep that in mind. If it's a kitchen remodel, of course, it's going to be a different price than a bathroom remodel. So the loan type or the loan amount varies according to the loan program. It's my understanding that conventional gives you a little bit more room for like structural stuff and loan amounts than the FHA. But remember, the FHA may take lower credit scores, and if you are just looking to do a quick remodel, cosmetic stuff, $20,000 on top of your purchase price, that may be the best way to go. If you are looking for a little bit more structural, then you may have to consider a conventional loan that is going to cover up to $50,000, $60,000 in addition to your purchase price. So it's all about the details. Typically, as we say, hey, those are the general rules. We will be able to give you more specifics when we see your income, credit, and your specific scenarios, so we can give you options.
One thing I've been doing, the longest I've been doing real estate, I have never done a rehab loan, and I don't know anyone personally that actually done it and has success, but obviously it's something that's offered, and I've heard people who have done it. I have not done one before, and I have people who ask me about it. And usually by the time, the people who are asking me are people who don't really have the financial means to qualify for much. So that being said, a lot of the things you mentioned about the requirements is not going to be a lot of wiggle room in there because of the amount they may qualify for. So there's certain qualification that has to be met. And that's something that I personally would not know. Now, Sheila's back on. She said, this is a great way to buy less desirable home and reduce your satisfaction. Opens more opportunities. That is absolutely correct. If we can get more information on the rehab, because oftentimes that is an issue with FHA property. The house won't qualify because it needs work. And if they don't have a rehab loan and the seller's not willing to do the work, then therefore you're not going to buy the home. Mm-hmm. It only conventional. And here's what I found though, even on conventional, it still has to be, certain things have to be done. They're not going to let you close if there's some major issues with the home, even on conventional loan. Right. Even if there's a swimming pool, like lately, for some reason, I've sold many homes with pools in the last 5 years. And swimming pools could be a deal breaker, even on a conventional loan, if there's a problem with the pool lining. Simple as that. So the bottom line is, that would be more desirable. Like Sheila said, if we can get people who can qualify for those loans and have some collateral to get the job done. And then also finding a contractor who's familiar with this, because not all contractors are going to wait till your loan closes. And I'm assuming that because it's based on your loan type, and obviously, unless you come out of the pocket, the loan itself pays for the rehab. Therefore, the person who's doing the work is going to be getting paid at closing.
Correct. So, and of course, in the last couple of years with COVID, and it has not been the most popular loan out there because there were not enough contractors to do the or complete the work. You know, people, you try to hire anybody, they typically tell you, I'll give you a call, I'll let you know, and then you end up following up with them because you never hear from them. So it is a program that is very helpful. But also you got to keep in mind what's going on around and make a decision based on those factors. Like, hey, you're going to be hiring extra people. Make sure that they are on time, that they show up, that they do what they say they're going to do, and the cost will reflect that. Because otherwise, it has the potential to be a headache.
Yeah, so like it all boils down to the time factor, because it can be a headache, but like Sheila said, it'd be a great way for a person to buy a less desirable home and get it fixed up.
Absolutely.
Because either way, somebody's going to fix it up. Somebody's going to rehab it, because these investors are snatching up these properties left and right. They're coming down south and buying up all our properties for our first-time home buyers. So the goal is to not to wait to the last minute to plan in advance and have a game plan. So if you have a goal of finding a home that you like that may not have the features you want, but you want to get a rehab and you have the room to qualify for that loan, let's map out a plan for that. You don't wait till you only have 2 months to move to do that type of loan. It's steps and levels to this, and finding a contractor that qualifies to be able to do the work. So this will be a good opportunity. And Sheila, she's a real estate broker as well. She's a real estate agent in Georgia. So I'm sure she's more familiar with that. And being out of Georgia, you will find a lot of people asking about that because the cost of the homes are so high. The cost of living is going up in Georgia. So depending on where you are, if the house needs work and you can get it done yourself, it will be less than having a rehab already rehab and purchasing it after the fact. Because once it's rehab, they're going to up the price anyway because of the money they don't invested in it, especially if you're buying a rehab home. And it may not even qualify for FHA because there's guidelines for it to qualify for FHA within the first 90 days or something like that. Or
well, remember, FHA, the government loans are there to protect the consumer. In this particular case, the buyer. So properties need to meet certain requirements. That way, the buyer doesn't come in and spends additional funds in things that needed to be already fixed. Mm-hmm. So with that being said, not all properties qualify for an FHA, VA, USDA loan. So keep that in mind. That the government set those measures in place because they know that those buyers may be a first-time home buyer and they don't have the funds to fix items. So that creates like what do we say? Hey, this property qualify for a government loan?
Right.
So that's always a good question to ask. Remember, when you come to a lender, they are going to pre-approve you based on your credit, income, assets, and also the property has to pass the guidelines for that particular loan type. So we do have guidelines in terms of going back to the rehab loans. I'll be happy to share with you guys our presentation for rehab loans, because I believe that there's the specifics. Everything boils down to, hey, the specifics, if that makes sense to you and you qualify for it and that's what you want to go for, that's what we're here for. And we have a presentation. I will be happy to share that with you guys and with your clients so you can make a decision and look at the information and details on our rehab loans. Yeah, because actually they may become more popular now. Based on what we see.
Yeah, I mean,
our market conditions.
I'm open to all options for my buyer, but I'm one of these people, like I said, it has to make sense. Does your situation allow for that? Like a lot of people who call me, who, even income, like I said, all plays a major role in what you can qualify for. So that is why it's important for us to be educated and get what we need to get our income up. We ain't talking about going and getting no 10-year degree to make the money. There's so many ways to make money now. find your way so that you'll be in a position to qualify for what you need, because the cost of homes and the cost of rent is going up. And with that being said, people are getting left behind and wanting to purchase, but they can't afford to do so unless they're going on with someone. And I'm not a big fan of, it's not really a co-signing. You both own the house. So if you get on a mortgage with somebody that you ain't got, it's no guarantee that y'all gonna be liking each other the next 5 years. It's not worth the headache. And don't put your kids on when it can prevent them from purchasing as well. It's not gonna mean they won't be able to purchase in the future, but it depends on that debt to income ratio.
Right. So
And
I
the
tell my
terms-
buyers at some point your income runs out, because remember, our lenders are only able to use what we are giving as the guideline. So, you still have to pay taxes, put money in, put gas in your car, buy groceries, insurance, get your nails done, go to the movies, et cetera, et cetera. The other portion is for basically monthly payments, what we call the liabilities, your student loans, credit cards, auto loans, housing. And remember, housing is the only one that right now is mandated by the federal government. So they are looking for those measures. And that's the reason we typically have to verify, hey, don't run out of income. Don't run out of income.
And in America, we want so much. We want to make up for what we didn't have. Or people just overspend. Even if you got the money, we still buy stuff, just be buying it. It comes with discipline. And that's the same thing when it comes down to something you really want. If you really want to become a homeowner, it's definitely a way that you can become a homeowner. There's always strategies, because people always ask me about these other programs out there, NACA program, and there's some, what is it, little homes community that they're building up. It all boils down to what you can qualify for in your overall situation. It doesn't matter what program you go through. If you don't meet the requirements, you don't meet the requirements. The goal is to make sure you meet the requirements. Right. Period.
And that's the reason we like having this conversation. So you get to know what's required, get ready, get prepared, know your information. That's the best thing nowadays, getting access to your information, your income, how much you can buy, and how much you're going to need at closing. That's so important.
And like we talked about the different down payment options in the last video, each state has their own programs. Matter of fact, it can be a county that has a program. Because in Montgomery, they have the different programs, like for the CRA, depending on where you want to live. Georgia has Georgia Dream, Chenoa, and a few other options out there. And the banks have their own down payment money and their own programs that's catered to buyers to meet certain requirements. Guild Mortgage, you guys mentioned 100% financing. Explain the Guild Mortgage 100% financing, not the Alabama Housing or anything like that. What is the requirement for Guild to provide the 100% program that they're offering across the board?
Got it. So we do offer, as I said, at Guild, we offer a couple of first-time homebuyer programs and 100% financing options. In addition to the Alabama Housing Program, which is the most popular one, we offer a 0% down. That's the name of the program. The requirement is 620 credit score. So
only a 620.
Mm-hmm, the debt to income ratio can go all the way up to 50%. You can buy anywhere in Alabama, and it does have a little income requirement. So it's always good to check to make sure that you don't go above that income requirement. But
is it only Alabama, or is it other states too?
Well,
I guess each state has their
that
own.
particular one is for Alabama. I think it's nationwide, and we do it with Guild Mortgage. So that one it is not going to have like a state requirement. It's offered all through where we have branches. You can ask for that 0% down program.
So I noticed that you and I were working on this transaction previously with a customer, and I think the main issue with her was her debt to income ratio.
Right.
Because it wasn't the credit scores. Her scores was in the higher 600, higher than 620. And so with that being said, how does the debt to income ratio impact that? I guess they don't make enough and they have a car note or something like that, or.
Well, in her particular case, we were talking about going with a different program, like Alabama Housing. Your debt to income ratio needs to be below 45%. So this other program we can have it all the way up to 50. We just need to see what the rate is. sometimes, on programs that offer more purchase power, 100% financing, the rate can be a little higher than the traditional FHA or Alabama housing. So that's where customers go, well, so just keep that in mind. That's why it's good to look at other options. Now, here's the thing, that there are buyers out there that need to have access to the down payment and also the closing cost. And I think it was more the closing cost as well, that she wanted a program that will cover closing costs as well.
Okay.
And having a program that will cover closing costs allowed her to say, hey, whatever I have saved, I can actually use it to purchase more house.
Mhm.
So that is definitely helpful.
Yeah, so she qualified for a lower amount because of her income, and she had savings. So my advice to someone, that's the reason why it's important to have savings, not because you don't want to have to pay anything or get anything or get somebody to do something for you. Having money gives you more buying power anywhere.
Which is what she ended
Because
up doing,
especially if you see a house you like and it's only a $10,000 different from what you're
Difference.
approved of, if you're already getting down payment assistance, you can actually add to that to get the home you like. Especially if it's something that's within your means financially, make it make sense. Have a plan that works for you. Meaning that if you actually see something you like, having
Mhm.
money saved will give you more buying power because you can add on top of your approval amount. No one said that you can't do that. You can always add to it. The bank is just not going to give you more. But also, we have to consider the more house you buy, your taxes and insurance can vary the amount that you're going to pay depending on the house. I don't think $10,000 is going to make that much of a difference in your
Right,
insurance.
right.
But I mean, that everything is factored in: the cost of the home, the location, your taxes, your insurance, whether or not you got PMI. All of that in fact impacts the amount. When you look on Zillow, Realtor.com, or online, and you see that mortgage calculator at the bottom saying you can pay $900 for a $250,000 home, that information is not accurate. First of all, they do not know exactly the interest rate or what program you're going with, and they don't factor in the taxes and insurance. Your insurance is based on your information.
Or the mortgage insurance.
The mortgage insurance is not factored in there, and your homeowner's insurance, just like car insurance, homeowner insurance, and everything else. Nowadays, believe it or not, some of these companies are pulling your credit to determine what you can qualify for. So your credit can be an impact on your amount that you pay for your car insurance as well as your home insurance.
Oh man.
Yes. Matter of fact, I know someone recently, it's time for your renewal for your insurance, and the insurance went up not only on the car, but also on the mortgage home insurance, not the mortgage insurance, but the homeowner's insurance. And you want to know why it went up on the homeowner insurance? Because something came back in LexisNexis saying that there was a change in their credit score, a negative impact. I guess that they had more debt. It wasn't that they had a lot of lates, but obviously they started using their credit cards more to survive because they had some other things that happened, which in turn dropped their credit score. So when it was time for the renewal for insurance, the insurance went up for the car insurance because of the credit FICO score. And I was like, wow, that's not fair. As long as you're paying your insurance bill, why would they even worry about what your credit score is? Unless you're having accidents. If you hadn't had any accidents or tickets, why are you worried about somebody's credit?
I hear about insurance companies leaving states like Florida and California just because the cost of continuing to offer the insurance is so high. So, I mean, things are definitely changing.
Yeah, everything is expensive nowadays. That's the reason why when we're talking about home ownership, people are like, well, I'm going to wait. What's your thoughts on that? We've talked about this before. and we bought homes 20 years ago. So, I mean, the rates were higher. Some people had 8%, even 12% back then. People were just buying. But guess what? The cost of homes were less.
Yeah.
They still pay high interest rate regardless. And it took them a while to pay it off. Now, either way, you either pay high interest rate or higher home. You have to decide on what you're going to do. You can always refinance down the line. And matter of fact, if you got good scores or you have a mortgage, you're going to be contacted anyway when that time comes because these people make a living that way. So when the time comes, you're going to get solicitations to refinance your home, just like you get solicitations to purchase a car. Same thing when the rates drop. Now, what's your thoughts on that before we end this video?
My personal opinion, and of course, most people say, well, you are in the industry. Is this how you make your living? I said, your decision needs to be in alignment with your personal goals. If you've been waiting to purchase a home and you're waiting for things to drop or interest rates to drop, it may take a little bit, you know. So if you are ready and you're able to purchase a home and also afford that monthly payment where you feel like, hey, that's really close to what I'm paying in rent, or it's not really that much of a change, go ahead and do it now because you will start building equity. You know, equity is basically the appreciation on your house, which most people have experienced in the last 3 years. I mean, people bought in the 115, now the house all of a sudden is worth 175. Same thing for a person that bought in the 200s. So don't, it goes back to your personal decision. My suggestion is get informed, know your options, know how much you can buy, and make a decision. You know,
The,
knowing your options.
the biggest issue is like she brought out what you really can afford. If you know you're not saving an additional $500 every month to go ahead and buy something and then having to pay $500 more than what you were used to paying, may not be in the best favor. And here's why. I tell anyone, if you're disciplined, it may work. But that's why somebody may have a foreclosure, because you're not used to paying $1,800. You were used to paying $1,200. Now you decide to go ahead and get a home that's almost $2,000 a month, and you were not used to that. You have no other financial support, like a spouse or significant other who's contributing to your household. Then that's a problem. So you want to. No one can tell you what to do, and no one is forcing you to buy a home. Although this is what we do. She's in the mortgage industry. I'm a real estate broker and realtor. Obviously, that's how I make a living. But I don't force anybody or tell someone you need to purchase when I know you're not in a financial situation. I have people call me all the time. I said, sweetheart, you're not going to qualify for no home right now. You need to get stable housing. There's programs out there for you. You might not even need to worry about buying because you're not going to qualify unless you're going on with someone, especially if you're on a fixed income and you're not going to have an increase. Sometimes it ain't worth the fight. Find stable housing. There's programs for those individuals who need that. But if you are in a position and you have stable income, you have enough income that you're paying high rent, it only makes sense to go ahead and get solidified and get something that's worth your time. We don't want you to buy a lemon, something that you're not happy with. But you can seek opportunity based on your situation and your location. Location plays a major role in what you're going to decide on, because no one has the same scenario. No matter what state you're in, no matter what city you're in and county, every place have their own perks, depending on what you're interested in doing. So you have to find what works for you. And once you've done it, you have to make a sound decision. Is it financial feasible? Do not put yourself in more debt trying to prove something to somebody, because really, if you're not normally saving about $400 or $500 every month and you decide to purchase and you're paying $400 or $500 every month, there may be a problem. Now, the perfect thing that I like about home ownership is when you're renting, you usually have to pay your rent by the 3rd or the 5th of the month. After that, you're charged a late fee, and they might even file an eviction by a few days after that. When you own a home, it allows for more flexibility in how you pay your mortgage. That when I was a single mom, after I had got my divorce and I was in my early 20s and I had a house, my mortgage payment was $1,200 and it went up to $1,600 because I had some type of adjustable rate. They really went crazy. And then I got a modification and put me back down to where I was at. But the thing is, paying $1,200 to $1,600, that's a big jump.
A jump. Yes.
The thing that allowed me to survive, because I still went on and paid it because I didn't want to lose my house. Having a mortgage allowed me more time to come up with the money. So when most people get paid twice a month, which means if I get paid on the 5th or the 6th of the month, my last check ain't going to be towards the end of the month, and I have other bills. But when you have a mortgage, it gives you more flexibility in how you can pay, and it put towards that and add on to it to your next paycheck, right? So that allowed for me to be able to afford it until they was able to do a modification. This was almost 20 years ago. Nowadays, that was back then. People paying more than that. So let's imagine 20 years ago, we were already paying $1,200 and higher for nice new homes. Nowadays, people are paying, you're not going to get no brand new home at $150 paying $1,200. It's just not going to happen. Okay. So that was well worth it. And the good thing about home ownership, when your rent is due, you only have a short time before you have additional fees. Most mortgage lenders, the payment's due on the 1st, you have until the 15th before late payment. And you're not getting charged late payment every week. It's just one time late for that month. And you still have 30 days to get the payment made to avoid it from hitting your credit and causing a late. That's why home ownership works. It allows for more flexibility and more sustainable living because it gives you more flexibility in how you pay because it belongs to you. You're not paying rent. You only have to pay the mortgage back because you have a loan, but that is your home. You can do whatever you want with that within the means of the guidelines of the community. So I hope that you guys enjoyed this live. This is our first live with Ileana. And
Thank you for having me.
And we're looking forward to doing more. And if she wants to come back on and share more information about the loan that someone asked about as far as the rehab loan, I'll be more than happy to have her on. We can do a live from your office, and we can do, we don't have to come in, or you can come in. Awesome. So I really appreciate those who tuned in today. Please click like and click share. And if you have any questions for Ms. Bird, tell them how they can reach you.
Absolutely. So I'm going to share my information with you guys. The best way to reach me is via email, or you can find me on Facebook or Instagram. You can send me a DM. That's the best way to reach me. Or you can just text me. I'm going to give you my number here. It's 334-730-3462.
Okay. Well, thank you guys, and have a wonderful day. Bye-bye. Bye.